Starting your trading career with a small account is actually the biggest advantage you can have. When you have limited capital, you are forced to build strict discipline and unbreakable habits just to survive. I learned this the hard way. Back in the late 90s dot-com bubble, I started with a $50,000 account. Because everything was going up, I quickly tripled my money and convinced myself I was a natural-born trading prodigy. But when the bubble burst, my reckless habits caught up with me. Within a matter of months, I gave back all those profits, plus my original balance, crashing all the way down to $2,000. The psychological toll was so heavy, I was having panic attacks just hovering my hand over the mouse. To build back from that, I had to completely rewire how I traded. By the end of this video, I will walk you through the exact step-by-step plan I used to protect small capital and force low-risk decisions. You need a system that removes the emotional panic and replaces it with mechanical, profitable precision. Let's get started. Step 1 starts before you even look at a chart. Get a physical kitchen timer and place it directly on your trading desk. This is your emotional circuit breaker. The rule is strict. The moment you enter a trade, set that timer for 10 minutes. Until it rings, you are strictly forbidden from looking at the stock or closing the position. Now that we have boundaries in place, step 2 is selecting the right asset class. Your choice here is dictated entirely by your available starting capital. This diagram maps out your options. If your account is under $2,500, your best route is utilizing a prop firm. If you have over $2,500, you should focus on penny stocks, microcaps, or leveraged stock ETFs because they offer the percentage gains you need without the massive upfront cost. One asset you must avoid starting out is zero-dated options. Mastering them requires advanced knowledge of pricing variables, called Greeks, and more importantly, they suffer from rapid time decay. You can be right about the stock's direction and still lose money. By forcing time delays with the timer and picking low-cost, high-leverage assets, you eliminate the two biggest killers of small accounts, micro-panic selling and premium decay. Step 3 is mapping your boundaries. We're looking at a 5-minute intraday chart of Palantir. This is where we apply the box theory. The opening morning volatility establishes the true boundaries for the rest of the day. Your first task is to identify the absolute highest and lowest price points reached during the first 15 minutes of the trading session. Once you spot those peaks, draw a rectangle connecting these highest and lowest early morning levels. This box is now your operational map. The absolute rules of this map are clear. The top boundary represents premium resistance. That's where the sellers live. The bottom boundary is premium support, where the buyers wait, which brings us to the cardinal rule of this setup. You never initiate a trade in the middle of the box. By ignoring the middle of the chart entirely, you protect yourself from random algorithmic chop and restrict your entries to highly predictable pivot points. Step 4 ensures the asset actually has room to move. You do this by checking the average true range, or ATR indicator, on a daily chart to find its benchmark movement limit. This chart tracks Palantir's ATR at $6. That means a typical daily move is $6 up or down. If the stock has already moved $5.50 by the time you look at it, the asset is exhausted. You should not buy it. If the asset still has range, step 5 is execution. You wait for the price to hit the extreme edge of your box, looking for a specific candlestick trigger known as a John Wick. This graphic shows the exact trigger. When a candle drops but immediately leaves a long wick rejecting off that bottom premium support line, it proves massive buyers have stepped in to reverse the momentum. Here's the exact execution protocol. You buy near that bottom line, you place a tight stop loss just below the low of the day, and you set your profit target at the top of the box. Combining daily ATR limits with specific wick rejections ensures you only risk your capital when the asset has both room to run and confirmed momentum on its side. Let's watch this play out. The price action bounces perfectly off that bottom premium support, catching the momentum and navigating directly up to your top target marker. That is the complete formula. Use the timer to enforce emotional control. Select a low-cost asset that matches your account size. Ignore the middle of the chart and execute only on premium triggers. Now it's time to put in the work. Open your charting software today. Pick a few volatile stocks and practice drawing those 15-minute morning boxes. If you need help finding the right assets to start with,
I've put a link in the description for a free gains guide. It provides a weekly watch list of the best setups to practice this strategy on. Long-term survival in this market does not come from having endless starting capital. It comes strictly from mechanical, disciplined execution. Stay patient, follow your rules, and your account will grow.